Thanks for tuning in to the All Funds Network podcast. Today we're here with Tyler Resch, JohnPaul Jonkheer of Le Mans Trading. Guys, welcome.
Yeah, good to have you guys.
Yeah, great to be here. Thank you, Mike and Skyler, for bringing us on.
Yeah, thank you both. Very happy to be here today.
Yeah. Cool. Let's do quick go around. Let's start with JohnPaul. Could you just give us a quick 30-second background on you? We'll dive into details in a minute here.
Sure. So I've been in the futures industry since late 2009. Started with a firm called IASG, which is a family-owned business started by my father in the early 1990s, and have been in the futures industry ever since. And started Le Mans Trading with Tyler in 2020.
Cool, Tyler.
Yeah, I started in my career late 2008 at a firm called MF Global, and it's familiar to all of you guys. I was a trader there, and then not long after I started, about a year and a half, I met JohnPaul in early 2010, and we've been working together for the last 15 years now.
Awesome. Well, JohnPaul, I want to kick it over to you. Let's start with just tell us what you guys are up to today at Le Mans Trading.
So, like I mentioned, Le Mans was started in 2020, co-founded by Tyler and myself. And really the idea, the genesis of the company was predicated on portfolio building, which we had really built our whole career off of at ISG. And when I say portfolio building, mostly in the commodity trading advisor space. So we would work with individual investors to build custom portfolios of CTAs that were diversified across different asset classes, different styles of trading. But ultimately, the portfolio itself was run and final sign off was done by the client, and then the ongoing maintenance of that portfolio was managed by that client, which is a great business. We still do that today under ISG's umbrella. But we wanted to have a little bit more control and came up with an idea through our experience of building a portfolio under this new company called Le Mans Trading, where we picked best in breed managers that we believed would be interesting and appealing to a wide variety of different types of clients. So in 2020, we launched the Hyperion Fund under Le Mans Trading. And that today is our flagship fund.
Very nice. Just a quick question for you guys. How did you guys meet? Obviously, 2020 is when you started the company, but how did that happen?
Well, I'll take that one, Tyler. So when I first came into the business in 2010, I was working with my father, and he had really built ISG kind of on his own. He didn't really hire outside people. And what I quickly noticed as technology was starting to change, we own a lot of people know ISG from its database of commodity trading advisors. Mm-hmm. So it was producing, so people would register on our database as they do today, name, phone number, email address, and it's a lead resource. Well, I wasn't going to call all of these people. There were enough of them that I wanted to build this out and bring people in. So I was kind of actively looking for people, and that's how I met Tyler. So we got along really well, thought he would be a good fit. He's been with me, working with me ever since.
Amazing. That's awesome. Yeah. So far, so good.
So far, so good.
Probationary basis since 2020.
Cool. So you guys at ISG, so it sounds like you guys were putting together like SMAs, separately managed accounts for these different clients. And then what was kind of the inspiration for you guys to start a proper fund of fund?
I'd say the SMA side, because that was always our bread and butter. We would sell that as a product and didn't really work in the fund space. So the fund space has a little bit different characteristics in that it has a little bit, the liquidity terms are a little bit different. Managed account, you can see every transaction, every trade that's made. You can get in and out of it at any point in time. It's a more emotional product. You can really get into the weeds and see every detail of everything that's going on. And not that a fund closes any of that off, but it allows the emotional component of being an investor in CTAs. It removes that layer of it, from our perspective. Tyler, I don't know if I add anything to that or.
Well, the only thing I would add to that is, one of the challenges that that we faced a lot on the SMA side, and this is over 10 years of doing this with JohnPaul, 10 years up until the point of launching Le Mans Trading, was that every customer has different limitations. They're different sizes. They're clearing at different firms. There's things that they can't clear and things they can clear. You've got a client with 500K and a client with 5 million, and you're trying to give them the best possible solutions to whatever problem they're trying to solve with this alternatives part of their portfolio. And ultimately, all these limitations were to the detriment of the client, to the detriment of the portfolio. And we thought if we could remove the limitations, we could do a lot better by the client. We could perform better. We could be more consistent. We take away all these limitations that are saying you can't access manager A, you're stuck with manager C. Well, what if we took a fund that we wrapped again, taking all limitations away, if we had our ideal portfolio and put it in a fund, and then you can have someone come in at 100K or 250K and own a portion of the return of this entire, dream portfolio. And I say dream portfolio in the sense that it was my and JohnPaul's dream portfolio. We look at our portfolio managers today, 9 strong, and can't believe that this is who we're working with, right? Now to recreate that portfolio would probably take between 15 and 20 million. And so that the clients that are able to do that, it means you have a portfolio of 100 million plus. That's 0.5% of the people in the United States. It's a very small pool. And so if you're not actually trying to access that pool of money, but you're able to give the retail public or retail audience, just individual investors, that same product, then we have something in the marketplace that's unique, that adds value. And we're finding that this was all a thought, right? This is a genesis of Hyperion. 5 years down the road, we're finding that we were right? We're adding value to people, to their portfolio, to their way of life. Yeah. And you find that an individual with 2 million has the same requirements for their portfolio as a family office with 500 million. They want consistency of returns. They want to not lose money, and they want access to their money.
Right.
Even in a fund product, they have access to their money. And with, again, taking away these limitations, we're able to try and come closer to achieving consistency of returns and a compelling, positive return at the same time.
Yes, I guess the 2 key things that I see there are you have a very high quality of manager in this fund, or in the fund of fund structure, and then the other side of it is when it comes to investing in some of these funds, you have to have a larger check size. So as a smaller investor, you can't necessarily invest in these funds, but this kind of unlocks it for them, right?
That's exactly right. It starts to unlock it. And then, the final piece is just being very active portfolio managers. The way that we approach a fund of funds, I think is somewhat unique, and a lot of it's modeled out after, on a very high level of what firms like Millennium are out there doing. We looked at Millennium, we're like, how on earth does anyone trade $30 billion and make 10% a year every year? It just, math, it didn't compute to us, right? So we're like, although we will never figure out that math, or they're smarter than we are, we can figure out how to trade $1 billion really well and do, the things that we're doing now with 50 million. And so that's, we're just trying to fine tune these things. And it comes down to very thoughtful allocations that are not equally weighted, but having a very deep understanding of what the strategy is meant to do, and then constructing a portfolio for a specific objective. So we kind of run this fund almost as a targeted return fund. Between 10 to 12% a year, we should return. And if our drawdowns are under 2%, which they are, then that's a 5-to-1 risk reward. It's compelling to anybody. And now we're seeing assets flow from passive real estate funds and private credit funds, because the returns are similar. We have better liquidity, and then we have better tax treatment with the 1256 futures tax treatment. We had to build the track record. We had to get over some AUM threshold, and we're sort of knocking down these doors now for these walls.
That's great. Yeah. Are you guys adding additional managers now, or you kind of?
I think, I was wanted to expand on what Tyler was saying, and that's a great question, Skyler, because the other edge that we have is we're always looking. So a big part of what we do on a maybe not day-to-day basis is we're looking for managers that are otherwise challenging to find, limited capacity, niche strategies that fit our model and what we're trying to do. And I think we've been really successful at doing that. I mean, we have small managers that, won't be able to grow to some of the size of the other components of the portfolio. And we're comfortable with that, but we're always looking to add strategies and evaluate talent to add to the.
Yeah. So talk to us about like the specifics. So when it comes to these managers you guys are looking for, is it, I guess just kind of, give us the rundown on that side of things.
Yeah. So like JohnPaul said, we do, my approach to all of this has been that the lower capacity strategies have the higher consistency, higher Sharpe ratio. And that logic sort of comes from the successful prop firms out there. A lot of what they run with like a 6 or 7 Sharpe, and it's been literally like a 6 or 7 Sharpe. They can't manage more than 10 million. That's the most that they can do with that type of a strategy. And those strategies never hit the public market, right? They always stay private in a prop firm or, self-contained in a family office or whatever. Because we're a fund of funds and we have more leverage that way, we can say, come work with us. We'll fill your capacity. And then we have access to these strategies that, like I said, otherwise we're never going to be accessible to the public, let alone JohnPaul and I.
Yeah.
So we do look for that low capacity. That is something that I think is generally holds true. That's not foolproof, obviously. But otherwise, we're looking for low volatility, and then we're looking for how do you generate alpha? We've got it's about 65% of the portfolio that is market neutral, so they make money 8 out of 10 days. Bullish, neutral, slightly bearish days, and then they stop out in excessively bearish days where the market's really rolling over. So we said, okay, it's a vulnerability. And if you're an alternative asset, you got to make money when the market goes down, right? If you've got a stock portfolio and you're the alternative component and you both lose at the same time, investors get real upset. So you better be, uncorrelated in that at that moment. So then we had to really find some expertise in how to generate long volatility profits. And so we found 3 strategies in the portfolio. So 3 of the 9, so 35% of the portfolio that is experts at capturing downside movement. So through long put spreads or outright long, it's a long VIX butterfly. So not just outright the front month, but long in a VIX butterfly.
With in terms of like the lower capacity strategies, that aspect's interesting to me. Is there given that, is there maybe a limitation to the size of the fund?
Yeah, that is there is a limitation to the size of the fund. If someone were to give us $2 billion tomorrow, we would not know what to do with it, right? We'd be in trouble. But we can easily manage about 550 million in the current portfolio structure. So you end up being limited by your lowest capacity manager and they're part of the portfolio. We're all over the place, right? So we've got one of our managers is 30%, and one is 8%, and this is all meant to give us the highest chance of a positive outcome on any market day, right? So we're trying to make money most days. But it does limit our capacity, and is why we need to continue to seek talent to be able to grow. We've probably got the next 3 to 5 years, figured out as we stand today. But we had a call before this call with a manager that it looks very compelling for Hyperion. So it's part of our day every day.
What do allocators or investors think about the kind of the fund of funds model these days?
I think that it's one of the more attractive options in the actively traded space. So, piecing or parsing alternatives down even further to just actively traded strategies over time. And it's also what the ISG business was built on, right? This idea of building portfolios, not just kind of marketing strategies. Over time, you have a smoother equity curve. So, by being able to kind of control these components within a portfolio, understand the strategy's vulnerability, and then trying to find something that's generating alpha when this other strategy is losing money, those types of approaches are what give you that, bottom left, top right, just ski slope equity curve. Or at least that's the intention. And that approach is the only thing that gives you a chance at succeeding in that. I think the returns are compelling enough to where that makes the case for a fund of funds, right? Like you look at the return stream and it's smooth and it's generally positive, and you go, okay, maybe the fund of funds idea makes sense. We're also not pioneers in this sense. Like I said, Millennium and Walleye and Valley S and Citadel, these are fund of funds that are trading, it might be trillions now. It's for a whole ton of money.
We're really selling our expertise at building a portfolio that would be otherwise just difficult, especially in an industry where a lot of people don't have a lot of expertise. And I'm talking about more like the high net worth individual with money that might know the equity and bond space, might have an advisor who really understands and knows that space, and they're comfortable in that. They're okay with volatility in that environment. It's what's taught. But when they're looking for alpha or ways to build onto their portfolio, which we think is becoming more part of the conversation, they're going to need to rely on people like firms like Le Mans and the Hyperion Fund to give them peace of mind that there is expertise behind building these strategies and making it relatable and understandable for those investors, how it fits into their portfolio, what the tax treatment is like. I mean, there's just a lot of things that they would otherwise not know that makes the fund of funds more appealing to
100%. Let's talk about the market environment. So commodities, I don't know, as long as I've been in the market, I don't know, maybe like 2010 to 20, maybe even 2022, 2023 have kind of been underperforming relative to some other assets. How are you guys looking at the current market environment, JohnPaul?
I mean, commodities is a little bit of a misnomer, right? So we work with commodity trading advisors, but the thing to always remember is we're really working in the futures industry, and in the futures industry, and a commodity trading advisor is trading all different asset classes, but their instrument of choice is doing it with futures. So we really like to look at the space from that perspective, where you can be trading indices, you can be trading currencies, you can be trading, obviously the commodities that people think about: oil, natural gas, corn, and those types of products. So I think it's important to point that out as it applies to Hyperion. The 95% of what's being traded in that portfolio are S&P 500 futures or options on futures. Mm-hmm. So it's really an equity-driven portfolio, which again allows us to make that a little bit more relatable. To go back to your question about actual commodities themselves, as standalone products, they're very difficult to trade. They require active management to be able to successfully navigate kind of the ups and downs. There are a lot of different products on the equity side that people can gain access to those products before. There was a lot of talk within the last couple of years post COVID about commodity super cycle, and commodities are going to become more difficult to keep at these suppressed levels, and prices are going to explode. But that was the headline of the day, and that's now kind of tapered off. So I think commodities as a standalone product can be a part of a portfolio if you're looking at the traditional commodity sector. Mm-hmm. And there's a lot of different ways to make investments in that space.
Yeah. On that note, how does a fund like this, coming back to Hyperion Fund, how does that kind of fit into a regular, a typical investor's portfolio?
It is I was talking about, you need to be uncorrelated to the stock market, just because that is what people are going to use as a benchmark, only in the sense that it is where a good chunk of their money is typically held. So you need to be value additive to what the S&P is doing, and the way to do that is to be negatively correlated, right? They've got cheap, easy beta for the S&P 500. How do you add value to the portfolio? And it's with a negative correlation. So you have to maintain that negative correlation, and then it comes down to fitting it in a portfolio. So everybody should have alternatives in their portfolio, and you do what you know. So whether that's real estate or something else, you should have something that's negatively correlated to the S&P, in the sense that the risks are not they're completely unique to each product. We add stability to clients' portfolios, and that really was the goal. So, most people in the alternative space are generally trying to knock the cover off the ball, do 20+% in a year. And what tends to happen, and there are some trend followers that this is just part of the design. So I'm not talking down about any specific strategy, but what tends to happen is, if you're a 20% plus returning fund, you're going to have some negative 10% years, you're going to have some negative 10% months. And over time, your average annual rate of return is, you're lucky to be in that 10 to 12% type of range that Hyperion is targeting. So we just thought, let's take away the headache and just return 10 or 12% a year rather than average that over a 7-year period. So we take a lot of the headache, the surprise out of a portfolio. In a month like April, we were doing very, very well because of the downside movement in the S&P 500. So we had real value in months like this. But over the down months that have existed for the S&P over the period of our fund's existence, we've been positive for all of them. So I think if there's like one key metric, it's, hey, we're not losing money when the market goes up, and we're making money when the market goes down. And there's something to be said about that. And then if you are, heavily allocated to private credit, passive real estate, and it's like a 10 to 12% type of annual return, we are a great alternative to that.
Yeah, it's a great point. I mean, as long as it's going up, I think that's really the only thing that matters, especially, during downturns like we're seeing right now. Kind of coming back to the like market environment, how do you guys think about that, as a whole right now? We touched on commodities a little bit, but maybe coming back more to like the stock side of things.
Yeah, I mean, you're seeing daily ranges increase like 5 times, right, over the last call it 8 weeks since volatility really kicked off mid-February. It creates a lot of trading opportunity in the option space. So we're very short term in nature. Most of the portfolio is turning over every 1 to 3 days. So it's a lot of manual lift. And in the option chain, when the daily ranges, go from 20 points to, 300 points, you can get smaller and be very conservative and then be reactive to the movement in the market. That long vol part of the portfolio is always very passive in there because you don't know when volatility will expand, and maybe the catalyst is an immediate event, right? Maybe it's something that moves the market almost in a flash type of way. So that part has to always be in the portfolio, but the market neutral can just go to cash, maybe stop out for a loss on the initial move, and then you wait for the market to do something to create dislocations, and then you just have to be nimble and take advantage of it. So like, on a day where the market's down 5%, we have great opportunities for the next day's expiration, even on this market neutral part of the portfolio that in theory really shouldn't find opportunity in a market like that. That's not the market where they're really designed to make money, but these opportunities come. And I mean, to give you an example, we had a short spread on the put side, 23% out of the money for a 12-hour hold. And that was like a 6 basis point trade for us. So that's a 99.99% probability trade, right? Like,
Yeah, right.
If you're in the market, you have to take that trade. So, we have people that do. So I think it's, you make great money on the long ball, but the market's not just rolling over. You saw on days like yesterday and today where you're getting big up and down volatility. So it's really just making sure you're not taking on too much risk on that initial move down, and then being very selective on where you take risk in the aftermath. But, ultimately, this is it's a very opportunistic market and should create a lot of opportunities for shorter term strategies like ours.
Let's take a step back here. A random question I want to throw out at you guys. What is Le Mans trading? What does that mean? Where does that word come from?
You thought of it, Taylor, so you take the reins on this one.
Yeah, I am a little bit of a car nut, but I don't want to pretend like this company has anything to do with cars. But there is a race that takes place in Le Mans, France, and it's an endurance race, a 24-hour race. And so, it coincides with a passion of mine, the automobile, but I also thought for a fund like Hyperion, this idea of the endurance race. And so, the idea that almost anyone can win in the 24 hours of Le Mans, you just need to be on that track for 24 hours. You need to keep persisting. And so that's why our tagline is edge with persistence, right? As long as we can find an edge that will persist, then we can make money in most market conditions. And it's, we will continue, we'll keep going. That's the longest running, longest duration endurance race in the world. And it's been around since the 20s, I think. I just always thought it was a romantic idea of something that, we do strive to be in a very different way. And then the name of the fund, Hyperion, is
That's going to be the next question.
so I didn't mean to jump in front of you, Mike.
No, it's
You're
perfect.
very good at your job, but it's the name of a specific tree in Northern California, a redwood, that is believed to be the oldest tree in the world because it's the largest tree in the world. And so that idea that you're going to be, grow, not just alive, but growing through all of these different cycles and market environments and continue to persist is kind of is the theme of our business, so to speak.
I like that.
Too many funds come out and then disappear, right? Or too many strategies come out and disappear. We want to be that one that continues.
Growth and endurance. I like it. When it comes to allocations from advisors, kind of how do you guys see, from an advisor's approach to allocating to alternatives?
Yeah, I think we're starting to get over the hurdle more with the equity advisor space. It's still a challenge. They still primarily will go to exchange traded products, ETFs and mutual funds to solve their problems. But we do work with a handful of advisors now that allocate directly to the fund. Part of the process, it was making us fit their mold, right? So they want to be able to run a report from their broker dealer that includes our product so that they can more clearly assess the wrap fee to the client, which makes perfect sense. So we're on the Fidelity platform with a QSIP number and can be purchased that way. So, you can run Fidelity reports. The real, like where I think it was a real turning point with RIAs was making money in 2022, right? When they had, because back then we were really just saying, get rid of that fixed income component, give it to us, right? We will manage that money better than your fixed income allocation.
Yep.
And for the ones that didn't, they watched fixed income and equity just fall together in 2022, just completely get destroyed together. And it wasn't like a knock the cover off the ball type year for us, but we were positive every month. And so I think that's where you start it starts to sink in, that negative correlation, thinking a little bit outside the box of what you learn, early on in your RIA career or in your Series 7 materials. Just kind of modern portfolio theory is modernizing again, and you need to rethink correlations a little bit. So that's a big component for us, was like making money when the bond market wasn't, and then RIAs rethinking that 20 to 40% of the portfolio. And then what is the alternatives part of the portfolio doing for you? Like, is it doing what you expected it to do? Is it adding value to your portfolio? What is it doing for you? Is it just diversification for diversification's sake? Then what's the point? But if you have trouble answering that question, then maybe looking at a product like ours would clear it up for you. And that's, we strongly believe those things. A point that I do like to make all the time is JohnPaul and I are investors in the fund, right? We're investors in the fund. We got family in the fund. It's not just something, we don't just preach this. We do fully believe this as a wealth management tool.
Yeah.
I could add something to the RIA discussion, just because, I think Tyler being on the front line, so his role is primarily to be talking with investors and advisors, is that another thing that he's become really good at is educating. So, we have to educate people about our industry. I mean, right down to, to the bare bones. So, giving that level of education to an advisor gets them comfortable to then go ahead, and we know how to tell that story. So it's not only having the education, but being able to tell that story concisely so that they can convey it. And I would also say that particularly this was an area that we wanted to put some emphasis on, was in the RIA space. I think we learned recently there's something like 25,000 RIAs in the U.S., which is really an astonishing number. And the amount of assets that they manage is well into the trillions. So the competition is fierce. There's a lot of people competing over and doing a lot of the same things. So we really think that our product differentiates them. It tells a very different story. It has a different role. And if they can get comfortable with being educated on it properly, they can relay that to their clients. And let's face it, an RIA is in the business just like we are. They want to make money not only for their clients, but it's a business for themselves. So if we can add value to the client and to the RIA at the same time, which we believe we do, we give them competitive edge in the RIA space. So
Yeah.
Yeah.
Absolutely. And the one thing you guys touched on this slightly earlier, but could you talk to us a little bit about the tax treatment side of this fund?
Yeah, so everything that we trade are futures contracts or options on futures contracts, and those are deemed by the IRS to be 1256 contracts. So is the SPX and a couple other things, but
Yeah, could you explain what that is for those that are listening?
yeah, so it's just an IRS distinguish that basically states that any P&L that comes from futures contracts is treated as 60% long-term capital gain and 40% short-term capital gain. So we send out a K1. Our audits have to be done by the end of February, and then they work on the K1. And so far, they've gotten them out before April 1st every year. So we get the K1 out. And then on your K1 is your net return. So last year we did 11.3%. It'll show that amount in dollar value. And there will be a C next to that amount. And what that C is saying is that this is 1256 income. So your accountant or TurboTax software, or, I mean, this is very vanilla stuff, right? Not obscure or hard to understand. They will take that number and split it 60-40. And you'll pay long-term capital gain tax on 60% of it and short-term on 40% of it. So there's no per trade accounting. It's very straightforward. There's, like I said, one figure on that K1 and it's subject to that treatment.
Yeah.
Fixed
Makes sense.
income.
Definitely advantageous. Obviously, a lot of these folks are in and out of these trades on a daily basis. So you still get that long-term capital gains, right?
Good point, Mike. We don't have any long-term holds in the portfolio, right? It's never happened and it never will happen. We'll never hold a trade for a year plus. So we're really taking advantage of that tax treatment. And then, the reason I do harp on other asset classes is, like fixed income, real estate, private credit, you're paying short-term capital gains tax on that entire return. So, it's something that I don't know is totally understood by all, but, looking at your return on a post-tax basis is important.
Yeah. I guess going back, guys, to what you talked about from an education process with RIAs and obviously talking about the tax treatment, the alternatives process. I mean, what are some questions that RIAs are asking, just as you guys are educating them on alternatives, like what is their allocation percentage, these days? What are they looking at from their underlying client perspective?
Yeah, I mean, RIAs are focused on, right now in conversations over the last several months, we're kind of like preparation for the new administration coming into office and perceived volatility and now realized volatility. And so it's like, they're trying to look, you're seeing more RIAs be more proactive to look for alternative products outside of the alternatives mutual funds that are available to them. And it's what JohnPaul said. It's, if I'm an RIA and I'm one of 25,000 in the country, how do I differentiate myself? Right. I think most of those do a good job of, wealth management and guiding clients along different stages of life or how to handle, accounts for children and all those things. You can't, from my experience, you can't do all of that really well, right? So like, we focus on that on our portfolio all day, every day. I don't know anything about these other things that the RIAs know all about, right? I'd have to hire an RIA to help me with all those things. So it makes sense an RIA would hire somebody to help this part of their portfolio and improve upon it. And so we're seeing more and more RIAs look for things that are negatively correlated, that have different risks than private credit and passive real estate. And then the liquidity is a big thing. The fact that we're liquid monthly and that a client can change their mind, pull their money back out and not pay a penalty or a fee to do it is really important, right? I mean, the idea of locking your money up for 3 years is kind of a big deal. So, and then we can take retirement money. It's a great retirement asset. The sell to the RIA is similar that the RIA is selling to the client. This is somewhat forecastable. So, I could kind of understand what my portfolio will look like in 6 months or 12 months. Whereas, some other things, you're just not going to be able to do that. So it's making money in this kind of chaotic period is really the biggest, the way that we can stand out.
Yeah. Or maybe not losing money in this environment.
Yeah. Try to take advantage of it because it's really we don't have excuses for not making money in volatility. We talk about utilizing volatility to our advantage. So when it shows up, you better make some money. So thankfully it's gone as planned.
You guys had mentioned earlier the conservative approach to investing and, kind of how it wins out over the long term. Kind of how do you guys think about, being conservative and, going about making these investments?
It's a great question, Mike. It kind of comes back to that portfolio makeup. So we have parts of the portfolio that ultimately cost us money 9 months out of 12, and that's by design, right? We're accepting this cost in the portfolio for this value add in this moment. And so you're saying in a year like 2019, where the VIX is at 12 all year, that part of the portfolio is going to cost me 2% of return. Okay. And then in 2022 or 2025, when things are, rolling over and feel, end of the world like at times, that part of the portfolio is going to go from -2 to plus 15, 16. And so it's just understanding that although they're absolute return strategies, they're not meant to make money in all market conditions. And then that's okay, right? That might be an advantage to us. And so just understanding those components and then sizing them right? You have to size based on risk, again, based on the impact of the portfolio. But the way that we get to a conservative result is by hedging out our risks the best that we can through that portfolio approach. No single strategy that I am aware of can do what Hyperion Fund is doing as a amalgamation of strategies. And that is the point. And then it's also, we're not here just to toot our own horns, but I will for a second. It kind of comes down to the management of the fund of funds and understanding your objective and then just being true to it. We hold that static portfolio from this month to the next month, to the next month, to the next month, with small changes that happen along the way because we learn things. But ultimately, the intention is to stay true to that portfolio because you don't know what tomorrow's going to do, right? It could be up 10 or down 10, and you can't plan for it.
Yeah. And on that note, Tyler, are you guys looking at any specific metrics in terms of these portfolios? Are you looking at things like Sharpe ratio, different statistics like that as you make these investment decisions?
No, we're not. It's a good question, Mike. And the only reason I'll tell you no is because what I was saying earlier is that these these strategies are not all going to meet a set standard, right? So the market neutral I might be shooting for a 2 to 3 Sharpe, whereas the long vol, it might be a 0.3 Sharpe. But if it's not losing, to the degree that the S&P is going up, and then it's generating good alpha when the S&P goes down, you have to kind of ignore these predetermined qualifiers, right? And then just focus on what the additive value is to the portfolio. So this is a really good question, and we're aware of what we like to see, but depending on what its purpose is for us, they can't all meet these same metrics at the portfolio level. So it's just that we have to be flexible in that way.
Yeah. Just a quick question, just from, obviously you guys have been doing this for a while. You kind of have built out your methodology, your process. What have you kind of learned? What are some hard lessons or lessons you've learned along the way that you wanted to share?
I'd say the most important thing with the fact that when we started this fund of funds, we didn't have the capital that we do today. We really learned along the way that we had to have a good diverse group of managers. Not that we didn't at the start, but with more capital comes the ability to add and put things in the portfolio that are additive and that complement each other. So having gone through this now for 5 years, we are very comfortable with the managers that we have. We're very selective with who we bring in, but having a good stable of managers has really benefited us and our investors.
Yeah, absolutely.
The only 2022 was that learning experience, and it's to JohnPaul's point. 2022, S&P was down 20+%, and we were positive every month of 12 months. But we missed a lot of that downside exposure. We were positive because our market neutral was taking advantage of the moves down. And so in 2023, we made a change that we know if we had 2022 to do over again today, it would be our best performing year. And instead it's a mild year. So that's one of those things that great learning experience. It's why we're having such a good 2025. But at the same time, it just digs at me. I wish I had that year back.
We all do. I got the whole list of this shoulda, coulda, wouldas. With the as we kind of wrap up here, any advice that you guys would like to give to somebody that's maybe starting their own CTA today?
Oh wow, starting their own CTA today. That's a great question. I have enough runway that you can be patient, right? So know that it's going to be a process. We having been in this space for 15 years, I think we were still frustrated at the pace of growth that Hyperion started with. And although now we're quite happy with what we're doing, I think it's like, so why didn't everybody realize how great this was from, in the first year? And I think that a CTA needs to have enough in the bank to give them a couple of years of runway to be patient and build a name for themselves, and then work on your network, communicate with people like JohnPaul and I, or people like you guys that have connections, and start to get in their brain space, right? You want to just let as many people know that you exist as possible, and then you got to put up the numbers, and then it if you've done the work, the money should start to come in. But build up a runway because it's going to take some time.
And take advice from outside people. I mean, there's so many people willing to help others. A lot of people start with, if you give yourself that runway, absorb as much knowledge as you can, because people are willing to help other people. I think in this space, it's not a huge industry. We're a fraction of the overall market, but I think people are willing to help others if they're going to ask. The other thing I would add is a lot of people are fearful or hesitant because of regulation. Being a regulated entity, and it means something. It changes how you approach marketing, how you approach trading. There are rules and objectives, but it's not insurmountable. You can't overcome those things. You can put pieces around you that can help you through that landscape. And quite honestly, there is a need for more talent. Going back to the ISG side of things and operating a database of CTAs, the number of new managers that are coming onto the scene has really kind of dropped off. There used to be kind of more of a funnel of people that would take those steps of becoming a professional trader, and there seems to have been a little bit of a taper. That trend has tapered off.
Yeah, that's interesting. What do you anything you could attribute that to?
I think that's why I mentioned the fear of regulation. I can't really put my finger on it. It is difficult to raise money. Those things definitely factor in. Those are probably the two biggest things that I can think. So inability to raise capital, and overcoming the regulatory hurdle.
Yeah.
Interesting. Yeah,
Definitely. Awesome. Well, JohnPaul, Tyler, this has been a lot of fun. Really appreciate you guys joining us. Where could people go to connect with you guys and learn more about Lamont Trading?
Please connect with us on LinkedIn. We're on LinkedIn, very active there. Lamont Trading, you'll find our page there, or come to our website, lamontstrading.com. We'd love to connect with you.
Awesome. Great conversation, guys. We'll make sure to include all that in the show notes as well.